Brendan, here with Mike Riley. We're your mortgage experts. And today we're going to be talking about the Fed cutting rates. That's one thing we hear repeatedly from realtors, and we see it in marketing. Well, the Fed cut rates. Why aren't mortgage rates dropping more, right? Well, the thing is, the Fed, when you hear the Fed cutting rates, they're really cutting long-term rates. Just kidding. When you hear the term the Fed cut rates, the Fed really cut short-term interest rates. While it has a small impact on long-term rates, which mortgages are based off of, it really doesn't paint the whole picture. Mortgage rates are based off the 10-year bond yield, inflation, and a couple other market dynamics. But when you hear the Fed cutting rates, it doesn't have as much of an impact on mortgage rates as you think.
Right, and sometimes it's even an inverse relationship, right? Which we'll get to in a minute. When the Fed acts, it's always front page news, above the fold. The Fed cut rates a quarter. The Fed increased rates by a half. What the Fed does on that day is almost always already factored into the markets. It's no surprise that the Fed does what they do in most cases. It's been known and factored into the financial markets for weeks. So sometimes if the Fed is expected to cut rates by a quarter, and they do cut rates by a quarter, it really has no impact on that day on mortgage rates, because that's what was expected to happen. And the big boys in the financial game, they don't wait for things to actually happen. It's all based on anticipation. What probably drives the market more on those days is not what the Fed does, because usually it's in line with expectations, but what the Fed chairman says in the comments after rates are lowered or kept the same or increased. Because the Fed chairman is talking about the Fed's outlook is in the overall economy for the coming months. So sometimes the Fed can cut rates, but the Fed chairman will say, well, this might be the last rate cut for 8 months because we really don't think inflation is a problem anymore. So the markets will respond the other way. There is sometimes an inverse relationship, as Brendan and I mentioned before. Sometimes when the Fed cuts rates, mortgage rates actually increase. There can be a lot of reasons for that to happen, but the main one is this. Mortgage lenders hate inflation because if somebody mails us a check every month for 30 years for the same dollar amount on a fixed rate loan, that check is worth less and less to us over time if there's inflation in the economy. So sometimes when the Fed cuts rates, they're trying to stimulate the economy to create and spur economic activity. Inflation sometimes comes about because of increased economic activity. So if the Fed chairman cuts rates, or if the Fed cuts rates, there can be inflation fears on the long end or in the mortgage markets where they go, oh, money's too cheap. People are going to start borrowing too much and spending too much. It's going to drive prices up. So sometimes mortgage lenders don't like when the Fed cuts rates because it could bring inflation into play later, which diminishes our cash flow over 30 years. That's kind of in the weeds, granted. Sorry, I didn't give you a heads up about that, but that's a little bit about the Fed meetings. You don't need to be an expert about it. You can call us, but you will sound like an expert to your buyers.
That's right. And so what does that really mean for you? It means that you shouldn't jump to conclusions when you hear that the Fed is cutting rates. Even though it sounds good and it sounds like good news, it might not always be. And that's important for you and your buyer to know.